The stock market is where anyone, whether it's your mom, grandma, or the local crackhead, can buy shares of public companies. Each piece of stock is called a share because it represents your share of the company's profits. And because each share is worth the same amount of the company, they're also called equities, because equity means fair. So if a company has 100 shares of stock and you buy one share on the stock market, you now own 1% of the company. Okay, but why the heck is it called a public company? Well, a public company is one where anyone, including your mom, your grandma, and the local crackhead, can buy shares. Whereas in a private company, only rich, important people can buy shares. When a company goes from private to public, it's called an IPO, or an initial public offering. It can be worth it to think about why would a company like to go public? There's a few reasons. One is because it allows them to raise money, it allows them to create more opportunities, to reduce the risk, and most importantly, rich, important people get a big payday. Okay, so we know what the stock market is and what public companies are, but why would I even bother to buy stocks? Why do people talk about them so much? That's a great question. I'm so glad you asked. You're so smart. People buy stocks for two main reasons. Number one is protection from inflation. Every year, the price of stuff goes up. The money in your bank account does not go up as fast. However, the prices of the stocks in the stock market increase faster than the price of other stuff increases. Now, this is not true for every stock market or every stock, but we'll talk about that later. The second main reason people buy stocks is to grow their wealth over time. Companies like Amazon, Meta, Google, and Microsoft have gone up a ton in recent years, making their early shareholders very, very rich. Okay, great. So if a company has a high stock price, that means the company is a good company, right? No, you idiot. The price of a company's stock is actually the least important metric in understanding it. First, you want to look at a company's market capitalization, or market cap, which is the price of a single share times all the shares in existence. So if you had a company where the stock price was $100 and there was 10 shares in existence, the market cap of that company would be $1,000. If there was another company where the stock price was $20, but there was 500 shares in existence, then the market cap of that company would be $10,000. So even though the stock price is lower, the company is larger and more valuable. Okay, great. So if a company has a higher market cap, that means it's better and I should buy it. No. Sometimes the market cap or the valuation of a company gets too high, and the company can no longer make profits or earnings to support its high stock price. You see, investors buy stocks based on how they think the company will do in the future. So if a company is expected to grow a lot, they may pay a higher price than the current profits justify. You can measure this by using the price to earnings ratio, which shows you how much higher the price of a company's share is relative to the profits that company is generating. Companies that have really high growth tend to have higher PE ratios because investors expect their earnings to grow fast in the future. So just like the Toyota Corolla is a great car, but you would not buy it for $1 million, there are many great companies that have valuations that are far too high. And when valuations get too high across an entire industry, it can lead to a bubble, which will eventually pop, causing big money losses. And by the way, that is the financial term for it, big money losses. When you're buying a company's stock, it's helpful to look at the fundamentals. You want to understand its price, its market cap, its cash, its debts, its assets, its liabilities, price to earnings ratio, its growth, the overall macro environment, the leadership team, and the possible risks of the business model. Okay, this is all so much. I wish there was a way to get exposure to stocks without having to do all this research and keep up with all this stuff. Well, it's your lucky day. Let me introduce the heavyweight, all-time champion of the stock market, the index fund. You see, just like how that lunchly you bring to school every day is a collection of different foods, an index fund is a collection of different stocks put together. Back in 1882, a guy named Charles Dow and another guy you might have heard of named Edward Jones came together and made the Dow Jones Index, which at the time was a basket of industrial stocks. Now, because the index was made up of several individual stocks, it was not affected as much by individual companies failing. So if you don't have the time to do constant research and keep up with the company earnings reports, index funds might be the way for you. Today, there are lots of different indexes like the S&P 500, which is the 500 biggest companies by market cap in the United States, or the NASDAQ, which is all the technology companies in America. The way that you buy index funds or any other stock is through an online brokerage account. Back in the olden days before you were born, if you wanted to buy and sell stocks, you had to call someone in New York and verbally tell them what you wanted to buy or sell. My God, can you imagine? These days, it's so much easier. Just click a button on a screen and you can lose all your money in a more efficient way. Now, if for some reason you don't want to lose all your money, you should understand how to categorize companies. First off, there's the market cap. Any company that has a market cap lower than 250 million is a micro cap. 250 million to 2 billion is a small cap, 2 billion to 10 billion a mid cap, 10 billion to 50 billion is a large cap, anything over $50 billion is a ultra cap. You can also sort stocks by theme. There are value stocks, where the price of it appears low relative to the quality of the company's fundamentals. There are growth stocks, where the company has a lot of room for growth in the future, and dividend stocks, which tend to be a larger, more established company that pays out direct cash to its shareholders instead of seeking massive growth. And then there are the different market sectors. There's energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, technology, telecommunication services, utilities, and real estate. Wow, that's a lot of categories. So how do I even know what to buy? Well, the only right answer in finance is it depends. It depends on your strategy and who you are. Are you a broke college student looking to gamble? Or are you a retiree looking for some side income so you can continue to go on 20 cruises a year? Answering those questions will let you understand what your risk tolerance is. How much are you willing to lose? Because I hate to break it to you, stocks do not always go up. For example, look at this chart of the S&P 500 in 2008. You would have lost a bunch of your money if you bought right here. That's because the market entered a bear market, which means the market consistently went down over a long period of time. Now, a bull market is the exact opposite, where the market makes higher and higher highs over a long period of time. Wait, let's zoom in. What are those little candle things there? I'm so glad you asked. The candlesticks show where a stock's price opened at and closed over the time period chosen. So if we chose a daily candle, then if the stock went higher that day, the bottom would show the opening price and the top would show the closing price. However, if a stock went down during the period selected, the top of the candle would show the opening price and the bottom would show the closing price. And the little gray lines or the wicks show the highest and lowest prices the stock hit during the day. Now, some people look at these candles and charts and draw weird squiggly lines over them to predict the chances of a stock going up and down. This is called technical analysis, but that's too complicated for today. If you think a stock will go up and you buy it, that means you are going long. And if you think a stock is going down and you want to bet that its price will drop, you are going short a stock. Shorting is a very, very risky strategy. It's not recommended for beginners at all, especially in a bull market where the stock market is going up and up over time. But that leads us to a good question, which is why does the stock market even go up over time? There's two main reasons. Number one is the productivity of a nation. If your country produces more stuff with less energy inputted, then the value of that country's companies will increase over time. And productivity can be boosted in many ways through innovation, trade, or having a business-friendly environment. And so conversely, if your country stops becoming innovative, has more restrictive trade policies, and an unfriendly business environment, then productivity will be negatively affected. The second main reason stocks go up over time is inflation. If the government prints more money and that money is used to buy stocks, that means the price of those stocks will be artificially increased. It's no coincidence that after trillions of dollars was printed in 2020, the stock market went to the moon. The downside of that is that the price of gas went to the moon, the price of rent went to the moon, the price of groceries went to the moon. It's a double-edged sword. You can learn more about the stock market by joining my Discord down below and going to the resources section. Subscribe to invest in this channel, and I will see you in the next video.